Have you ever stopped to wonder who truly writes the rules of our global economy? It's not in the fiery speeches of politicians or the bustling trading floors of Wall Street. The real power, the kind that shapes the destiny of nations and the flow of countless trillions, has often been exercised in quiet, sterile rooms, far from the public eye. This is a story about one of those rooms. A story of quiet panic, of immense power, and of a secretive committee that, with little more than technical documents and sheer will, fundamentally rewired the entire global financial system. They were the architects of a silent revolution, and they worked from a small, unassuming city in Switzerland. This is how the Basel rules came to be, and how a group of bankers, whispering in conference halls, learned to tame the global leviathan of finance. Our story begins not with a boom, but with a shudder. The post-war world had built a magnificent engine of prosperity, a global banking system that connected continents and fueled unprecedented growth. Money flowed across borders with a new, intoxicating freedom. But this new interconnectedness had a dark twin: systemic risk. A bank could now stumble in London, and the tremor would be felt in Tokyo and New York. The entire financial world was becoming a house of cards, beautiful and precarious. And in the shadows, the bankers knew it. They were playing with fire, with complex new instruments and vast loans piled upon a foundation that was never designed to hold them. The fear was palpable, a cold dread in the pit of every central banker's stomach. They saw the dominoes lined up, waiting for a single push. They needed a circuit breaker. They needed a set of rules that everyone, everywhere, would agree to play by. And so they gathered in Basel, Switzerland, a city of old-world charm and modern anonymity. The meeting rooms were bland. The coffee was mediocre, but the stakes could not have been higher. The men who filed into these rooms were not celebrities. They were technicians, pragmatists, the high priests of high finance. They represented the most powerful central banks on Earth, and they shared a single, terrifying secret. Their own system was a ticking bomb. The goal was deceptively simple: to create a global standard, a minimum level of capital that every bank in every nation would be forced to hold as a buffer against disaster. But the devil, as always, was in the details. How much capital is enough? How do you weigh the risk of a loan to a multinational corporation against the risk of a mortgage on a family home? The debates were fierce, a clash of titans disguised as a technical discussion. National interests collided with global necessities. The American delegation, with its vast and complex markets, pushed for one approach. The Europeans, with their own traditions, pushed for another. It was a tense, years-long negotiation, a poker game where the chips were the stability of the world economy. And then they emerged with their first creation, a dry, dense document they called Basel I. Its central idea was elegant in its simplicity. Banks must hold capital proportional to the risk they take. It categorized assets, assigned weights, and drew a line in the sand. For the first time, there was a common language of risk. The world's financial regulators breathed a collective sigh of relief. They had built their fortress. But the bankers, the very people these rules were meant to constrain, were already looking for the cracks in the walls. They were innovators, after all, and as the rules solidified, a new industry was born in the glass towers of global finance: financial engineering. If a loan to a risky corporation required too much capital, they would simply bundle thousands of those loans together, slice them into intricate new securities, and use the magic of mathematics to make the risk disappear. They were arbitraging the rulebook itself, creating shadows where the light of Basel I could not reach. The fortress, it turned out, had a back door.
The system grew more complex, more interconnected, and more dangerously opaque. The buffers that Basel I had mandated were being systematically eroded by financial wizardry. The regulators watched, their unease growing with each new, incomprehensible derivative. They had tried to build a cage, but the beast had learned to pick the lock. The confrontation was inevitable. The quiet man of Basel had to go back to the drawing board. The result was Basel II, a monumental, labyrinthine attempt to outthink the bankers at their own game. It was hundreds of pages long, a Byzantine codex of financial regulation. Its philosophy shifted. Instead of simple categories, it would use the bank's own sophisticated internal models to judge risk. It was a breathtaking gamble, a decision to fight fire with fire. The regulators, in essence, were saying, "You are so clever? Fine. You tell us how risky your activities are." It was a treaty signed with the devil of complexity. For a while, it seemed to work. The financial world entered a new golden age, a period of stunning profits and booming markets. The rules were in place. The smartest people in the room were now officially in charge. But this was an illusion, a calm before a storm of historic proportions. The reliance on the bank's own models created a fatal flaw. It assumed that the past was a reliable guide to the future. It assumed that risk could always be neatly quantified. It failed to account for the one thing that no mathematical model can ever capture: sheer, unadulterated human folly. The complex chains of debt, blessed by the very rules designed to contain them, stretched to their breaking point. And when they finally snapped, the world was plunged into the abyss of the 2008 financial crisis. The fortress of Basel had not just been breached, it had collapsed from within. The quiet men had been outmaneuvered by the consequences of their own complicated design.
In the devastating aftermath, amidst the wreckage and the public outrage, the architects returned to their quiet rooms in Switzerland. There was no glory this time, only a grim determination. They had learned a brutal lesson. Complexity was the enemy. Their response was Basel III, a set of rules forged in the fires of failure. This time, there were no elegant compromises. The new rules were tougher, simpler in their core demands. They forced banks to hold more capital, and crucially, a better kind of capital: real, loss-absorbing equity. They introduced buffers for good times to be drawn upon in bad times. They sought to leash the wild, interconnected beast of the global banking system with chains that were shorter, stronger, and far less easy to break. It was a monumental undertaking, a grudging admission that their previous attempts, for all their intelligence, had been insufficient. They were trying to build a system that could survive not just a crisis, but also the ingenuity of those who would profit by circumventing its defenses. Conference rooms, by committees, in the dry, technical language of capital adequacy and risk-weighted assets. They are a testament to humanity's endless struggle to impose order on the chaotic, powerful, and essential engine of money. We all live in the world that Basel built. A world a little safer, perhaps, but one forever balanced on the edge of a razor, where the whispers of a few in a quiet Swiss city still echo in every transaction, in every loan, and in the very fabric of our global wealth. The game is never over. The rules are always being rewritten.